Hello, hello. With Alphabet being down about 35% since its 1 year high, and more than that since its all time high, it's about time to take a little bit of a fresh look here at the stock. Is it a good time to buy? The stock is sitting at about $100, so it's a whole number. Is this the time to buy if you don't own the stock already? Of course, we'll examine the financials like we usually do here in this channel, but we will also take a little bit of a closer look at the company's pretty much business endeavors. So let's first dig a little bit deeper and see what the company is doing in terms of its business model. And you will see that Alphabet's Google revenues are pretty much, for the most part, about advertising. And in this chart, you can see how this is laid out. Google Cloud is about 7% of the whole pie over here, the revenue that they are generating. And it's sitting at about $20 billion in terms of its Google Cloud, which is about 1/3 of the main competitors like Amazon AWS, for example, or Microsoft. Now you will see that Google Search and other get the largest piece of the pie with about $150 billion, a significant difference over here. And it's AdWords that pretty much gets the medal, the gold medal. And in terms of the other pieces, I should say, of the pie, you will see that Google Other, like Google Play Store, hardware, and YouTube paid members, I think this is called like YouTube Red or something of that sort, subscribers pretty much on YouTube, are classified as Other. And this is generating about $28 billion, with the YouTube ads themselves generating about 28.8, kind of indicating that paid members are a big piece of the pie. I would expect these YouTube ads to generate a larger amount of the revenue, but it still looks like it's not as much as when compared to, for instance, AdWords, which is the other part of advertising through Google, for example. And of course, the nice thing to see here is that there is a room for growth. Take a look at this growth. 2019, the company was doing about 15 billion. In 2021, 28 billion. So they almost doubled their revenue in 2 years. So that's great. That's amazing to see for the company. And there is definitely a lot of room to grow. Advertising is still, in its infancy in a lot of countries, because I remember Google has a lot to say about the international field as well. And, there are many countries that are still in their infancy in terms of digital advertising. And you will see that Google Network members, $31 billion in between AdMob, AdSense, Google Ad Manager, and the likes. A very interesting piece, a very interesting pie over here, which kind of tells you how revenue gets generated in Google, or I should say Alphabet. Now, some other interesting news pieces. Google faces claim from UK publishers over online advertising. Interesting to see. Now, Google was sued on Wednesday by a group of British website publishers who alleged the US company and its parent Alphabet abused their dominant position in online advertising, depriving them of revenue. Is an interesting news piece that I discovered. And this goes along with New Zealand also plans on laws that in order to force Google and Meta to pay news publishers for content, because they are pretty much using the content of the country as news feeds. And you will see that New Zealand intends to require large tech companies like Google and Meta to compensate local media companies for content they use and share on their platforms. And finally, the other thing that is very, very important and an interesting news piece is the fact that Google is planning on significant layoffs. You will see that they are about to lay off about 10,000 employees. That's a very, very significant amount. And it's about, even though the number is large, of course, it's about like 6% of the overall workforce. So it's not so much compared to the overall workforce, but it's a very, very large amount in terms of its absolute number. And a lot of other big tech companies are, in a layoff season pretty much, with the economy getting dragged down, and the stock market crashing pretty much this year. We are looking at companies laying off quite a significant amount of people. Now, we will examine the stock because, again, it has been battered down quite significantly for a stock of that caliber. So what's going on with the financials? Now, again, if you take a look at the 5-year chart, you will see that the company was pretty much climbing, and then all of a sudden, I guess, things happened. Now, for a while, the company was sitting at a small range over here, at a predefined range, I should say. But then it started climbing and climbing. Now it's retracing a little bit. The P/E ratio of the company is sitting at about 18, and you can kind of see in this chart where you can click in our tool and see in our chart here that this has been heading downwards, which is obviously a nice thing to see. Has to do with the price of the stock, of course, as well as the profit that the company generates. But as the stock is going down, will be going down as well. It's a great thing for investors. Same thing with the price to free cash flow, which is even better here, sitting at 9. Wow, that's very, very low, understandably great, pretty much. And in terms of outstanding shares, also going down because the company is buying back shares. Now is the time to buy, it looks like. It looks like the stock is relatively cheap compared to what it is, compared to the value that it has. A company that doesn't have pretty much, has, or I should say, has very little debt, very few liabilities compared to the free cash flow that they generate. And take a look at these growth numbers. There is substantial revenue growth, net income growth, free cash flow growth, and total equity growth. And the company doesn't have debt. Take a look at this one. The company has almost no debt, 0.1%, like 10% of its equity is pretty much their debt. And the margins of the company are also very impressive. At some point, they were even 30%. Now they have retraced a little bit, but they are still sitting at about 24, 25%. Usually, they are even a little bit more than this one. Now, the company's financials, the financial statements, is what we're going to be examining next. And they're impressive, to say the least, because the company has pretty much more than doubled their revenue in the last 5 years, from 111 billion to 257 billion in 2021. And in terms of the net income, the growth is absolutely insane, from 12 billion to 76. Absolutely insane growth. Take a look at these numbers here. The growth numbers are amazing to see, otherworldly, I should say. In terms of the balance sheet of the company, we are looking at total liabilities that the company has that are more than $100 billion. Imagine the size of a company that has almost $110 billion in terms of liabilities, a scary number. But when you look at the total equity, you're not scared so much anymore, because the total equity is sitting at $252 almost billion. It's a very, very rich company. And if you take a look at the cash flow statement, what is even more impressive is the amount of cash flow that they are generating. It is absolutely insane. Because if you take a look at it, you will see that they are generating 67 billion, like this was last year's free cash flow, 67 billion, with a total liabilities of about 100 billion. They can pretty much pay it very, very quickly, a year and a half or something of that sort, if they wanted to. Now, the operating cash flow that the company generates about $92 billion after the adjustments for stock-based compensation, depreciation, amortization, and all the other elements. These are the big numbers here, the stock-based compensation, and depreciation, and amortization. As you can understand, this company is paying a lot of stock to their employees. This is what the big tech does with stock-based compensation, especially in the Bay Area. And of course, depreciation and amortization in these large companies makes a ton of sense. In terms of investing activities, just $35 billion, which is a small number compared to what the company is generating, it looks like, and it's mostly capital expenditures. And in financing activities, the company is paying back some debt and, of course, repurchasing common stock, the thing that you love to see as a shareholder. A lot of stock is being repurchased. And, they started from 4.8 billion, they're taking it to 50. So they're using their cash reserves to buy back stock as it's getting cheaper. Makes a ton of sense again. Free cash flow from $24 billion to 67. Another great thing to see here, a very, very rich company. So things are looking great. But what about the valuation? Of course, this company is not paying dividends, so we will not be using our dividend discount model, but we will use our cash flow model. So the company's projection is for about 8 to 10% revenue growth in the upcoming couple of years. Then it's probably going to shoot upwards. So we're going to use these numbers. We're going to go 8, 9, and 10 here for the growth of the company in the next 5 years. That's the annual growth. In terms of net income margins, right now there's, I should say that last year they were at 29%. Now, remember, if we go back, I can actually show you over here in our metrics. 29% is what they did last year, but if you take a look at the recent quarters, it's been going down a little bit. Now, you can see it here in the net income margins in the recent quarters going down a little bit from the 29%. So we're gonna go somewhere in between. So let's go back to our tool over here, the stock evaluation tool, stock evaluator, and again we're going to use 8, 9, and 10. And in terms of the net income margins, we're going to go between 25 and 29. I'm gonna go 25, 27, and let's go 28 instead. Let's not surpass 29 or go 29. And the free cash flow margins that the company generates, for the most part, 80, 90, and 100, I think makes a ton of sense. And the annual return is going to be 13%. Now, when I hit calculate here, you will see that two of these values are red, 74 and 93. This one is very close to the current price, and the high is green. And you may be thinking, okay, is this a buy? Is this not a buy? Now, I have bought this company at about 120 bucks, I think it was when I bought it. And I still thought that when I bought it, it was a great bargain. And the reason for this, even though it is more lucrative, more expensive than what you see here, the discounted cash flow model, you have to account for all the positive things that the company has already generated and the things that are upcoming in the future. What are these things? Why are these things important? So let's go back and take a little bit of a quick look. Very, very important things. Outstanding shares are going down and the company keeps buying stock. So your stock is going to be even more valuable. The company's key metrics, the growth numbers are amazing, super insane for a company of this size, especially their net income. Take a look at this growth. It has been growing tremendously. And it's projected to keep on growing, maybe not at the same pace, but still keep on growing for a company of this size is amazing. The company has no debt, the debt to equity ratio very low, current ratio very high, and total liabilities to free cash flow 1.61, a very solvent company over here. Return on equity that is great. Pretty much amazing things here to see for the company. That also has a huge moat. It's a company that is almost impossible to compete with. Very few companies can actually directly compete with Alphabet, and more than likely they are going to lose, unless maybe you are Meta or some other behemoth of that sort. But as you can understand, with a company that has its stock price down more than 40% since its all-time high, you can pay a little bit more. It's always important to make sure that you are buying good companies, and even if you pay a little bit more for great companies, it's probably worth it. It's more than likely going to be worth it in the upcoming years, because unless you are playing with like many $1 million, frankly, a difference of like 5%, it's not gonna be super significant. Either it's even if it's up or down, if you buy it cheaper or more expensive. What really matters is getting these kinds of amazing companies at a low price compared to what this company is, of course, compared to the value, as it's going lower. And if you want to be buying even more, then you can dollar cost average. So maybe you don't want to buy your 100% lot, you can buy 50% or as much as you want now, and wait for a potential drop, which could happen if the stock market keeps crashing. But I think right now, even right now, I think this company at $100 is definitely a buy. Even though again, it's a little bit more expensive than what the discounted cash flow model would suggest, I would definitely be buying this one today. And thank you for watching. Remember to like, that helps a ton. And of course, Patreons can have access to everything that I have shown you here in our tool. All the links in the description box below this video. I'll see you in the next one. Many videos upcoming, because we're going to be revisiting, I should say, the big tech stocks, analyze them, and other stocks as well. So stay tuned, more to come. I'll see you soon. Bye-bye.